Greetings, everyone. This is Cathie Wood from ARK Invest. Once again, it's Employment Day. So we like to give you a sense of what we think is going on out there that isn't really being either mentioned or really delved into very much by the media. So as usual, we'll start with fiscal policy, then monetary policy, and then we'll talk about the economy, and we'll spend a lot of time on the economy mixed in with some other signals, market signals that we're seeing out there. And then lastly, we'll talk about China. China has been causing a lot of drama, I think, in the markets, and we'll explore that a little bit. So first, just to summarize what we're thinking, we still believe that there is a tug of war going on in the market from a rotational point of view between value stocks, which are more cyclically oriented, and growth stocks, which include the innovation stocks, which we spend all of our time researching. So it's a very interesting time, and it seems to be centering around the economic statistics that are coming out. So when there's strength in economic statistics and fears of inflation and higher interest rates start surfacing again, we get a move towards value. And vice versa. When there are weak economic statistics or surprising low inflation or interest rates, then the growth stocks tend to have their day in the sun. Now, as you know, we believe this is going to resolve on the side of growth, and maybe sooner than a lot of investors are expecting. There are a lot of very interesting signs popping up right now that we'd like to share with you. But before that, we'll start with fiscal policy. So tomorrow, Saturday, the Senate is going to vote on the infrastructure bill, $550 billion. And it's a sensible infrastructure deal. It's all about infrastructure, which is what it should be from our point of view. Now, the vote, however, has been hung up. It was supposed to take place on Thursday, but it was hung up, interestingly, by some controversy around crypto, how to pay for some of the infrastructure bill with taxes on cryptocurrencies and crypto assets. And we believe that behind the scenes, there's fierce lobbying taking place. We do believe that the financial services lobby is particularly strong and has the ear, especially after the crisis in 08-09, has the ear of a lot of politicians. And so we believe that the tax that they're trying to enact here would really harm the evolution of DeFi, decentralized finance, which is based primarily on the Ethereum network. As opposed to Bitcoin. Now, we're not happy about this at all. And in fact, we worry that our legislators could, with an act like this, chase away technology from our shores. Already, the U.S. has had a terrible reputation in terms of regulation around crypto assets, partly because there are so many regulators and they don't agree with one another on even what these crypto assets are. We believe they're a new asset class, but I think our regulators have been trying to put them into an existing asset class and treat them accordingly. We are hoping that they will be getting a lot of pushback. In fact, we are hearing they're getting a lot of pushback with voicemail. Who uses voicemail anymore? But voicemail apparently for many policymakers full. It's activated a lot of the crypto community and a lot of the innovation community because we don't want to chase innovation away from our shores. And I think that if we were to frame this and say, and I'll quote John Lilly, who was on our brainstorm today, if we were to frame this and say, this would be a lot like regulating and taxing the internet in the early 90s, before it was really a gleam in the eye of many businesses. That would have been a very bad idea because the internet has been very good for the US, for innovation in the US, and has added a lot to our productivity and to the productivity of the world. But I think in terms of capital markets, the US really capitalized on the internet. Well, cryptocurrencies and much of DeFi is effectively unfinished business from the early 90s, and actually even earlier than that, when DARPA created the internet. No one at that time dreamed that that the internet would have anything to do with commerce, because it was for academicians, it was for intelligence agencies, for government, other government agencies, and it was never intended for commercial activity. Well, that was a miscalculation. And as a result, we never built into the internet a payment system. And we have a chance now to do that and add even more to the productivity of our economy and the global economy. And so, cryptocurrencies we've described as really money over IP. And we likened it in the old days to voice over IP to help people understand, at one point, and this would have been in my life, I never dreamed that I would be able to make telephone calls for free. And it changed my life. My children can't ever imagine ever paying for a phone call. So, and we think that costs are going to come down and benefit the entire economy, the global economy, and that trying to shut it down now would be a very bad thing. And I would say that our regulators then would be blamed as innovation moves to other countries, would be blamed for preventing the US from enjoying the next big thing. So I know that there's a Wyden amendment that is trying to address some of the problems that have cropped up. And so we're definitely following that and hoping that it will succeed. So one of the other things to note about fiscal policy is this $550 billion infrastructure bill might be held hostage, even if it passes the Senate, might be held hostage in the House to the $3.5 trillion bill that the administration is trying to push through as its primary agenda. And it would describe this as human infrastructure or human capital infrastructure. So even if we get the 550 passed, this $3.5 trillion, I think, will be a very long bet, mostly because it will include onerous taxes, which, as we move towards the midterm campaign season, will not be a good look. We do not believe it will get through. So We'll see what happens with the $550 billion infrastructure bill. I do believe it has bipartisan support and probably should go through. And ultimately, reason should prevail and probably will go through. Monetary policy. So interestingly, M2's growth rate has been unwinding since February. It peaked at 27% and it's now roughly 12%. So it's been cut by more than half. And we are also hearing from a monetary policy point of view, even the doves on the Fed, those who are more prone to easier monetary policies, even they are saying, based on the employment reports we're going to get, if they are strong, as more and more people come back to work after September, if they are strong, then tapering should start. Now, what does that mean? What that means is today the Fed is buying Treasury securities and mortgage-backed securities to the tune of $120 billion per month. And what they will do is just buy fewer of those. And so we don't think it's going to amount to much. We know there was a taper tantrum. I think it was in 2013. That's where we first heard that phrase. I don't think the same thing will happen now. We're on much firmer footing post 08, 09, and the European sovereign debt crisis, at least for now, has been allayed. So we do think there will be tapering. We think that's a good idea. We do think that the economy is on firmer footing, but even the people who say we should taper do not believe we should start raising interest rates until 2023, at least as things stand now. So both from a fiscal and a monetary policy point of view, we have a supportive backdrop, we believe, on balance. Now, employment reports, we did get one today, of course, and it was strong. It was very strong. And in fact, it erased some of the weakness that we noted in last month's report. Most importantly, the household measure of employment increased by roughly 1 million people. Remember last month it was down, it was negative, and we were wondering, this includes a lot of small businesses. What's going on here? Well, if you look at the NFIB index, that is the National Federation of Independent Business, it had been tailing off in terms of optimism and has hooked back up. And perhaps it is because they now see that it's going to be easier to hire people now that the 26 states, I think, have stopped topping off or using the Fed's top off to the unemployment benefits to encourage people to go back to work. And I do understand there are other issues about going back to work, childcare, and so forth, but at the margin, this should be good for employment. In terms of the report today, which was for July, the numbers were very good. The unemployment rate dropped by a lot, actually more than we normally see it drop in a strong recovery from 5.9% to 5.4%. And hours worked in last month's report were revised up, which means it was a much stronger month than we first thought. Wages were up 0.4%, so a little higher than the 0.3 expected. But if you look at them on a year-over-year basis at 4.2%, they are now rising at a slower pace than the CPI, which is up 5.4%. So what this means is employees or wage earners are losing purchasing power in this period of rapid price inflation. Now, the price inflation has been associated with shortages, supply chain problems, as well as the base effect. last year the prices dropped so rapidly. We should be cycling through that now. And there is evidence that on the supply chain front, we may be cycling through that now more than many people uh, may anticipate. So let's talk about that a bit. These shortages can often become the narrative as companies are trying to explain why they're missing their numbers, when what is actually happening is demand is disappointing expectations. And we're seeing this now happen in the housing market and the auto market. Let's start with autos. Now, these are signs of weakness at the margin, and I pay a lot of attention to them because of the inventory uh, confusion that occurs at turns in the cycle. So auto sales, for example, in July were 14.75 million units in the United States. This is a US number. Now, that disappointed expectations of roughly 15.4 million. And that 15.4 million estimate was made with the full knowledge that chip shortages are causing supply chain problems in the auto sector. Now, it's instructive to do a monthly update like this because I thought to myself, well, I thought I remembered an 18.5 million unit auto sales month. When was that? 18.5 million unit sales was in April. That was the peak. And now we're down to 14.75. That's a big drop, more than roughly a little more than 20%. And so in trying to figure out, okay, is this related to chip shortages? Or is it something else? Well, I listened to the Magna report today, which is an auto supplier. And one of the analysts asking a question said, were you as surprised at GM's sudden change in its forecast? Were you as surprised as we were? And they were very diplomatic. I think they said, well, it wasn't any one company. It was everyone seemed to be surprised at the same time. And what doesn't make sense to me is auto manufacturers, they line up supplies ahead of time so that they can forecast. They tend to be very good manufacturers, and this is what they do. So I think something has changed. I think something has changed on the demand front. And we have some evidence of that as well from used car prices. So used car prices, as measured by the Manheim Index, have fallen for the last 8 weeks. I didn't realize until I looked up the Manheim website that they do this report weekly. And so now for 2 months, we've seen decline in prices. The last 2 weeks showed the biggest decline since last fall. And they also noted that auto loan credits were deteriorating. So this tells us that the auto sector is weakening, and it's more a function of demand, given that we're talking about used car sales here, than it is of supply and supply chain shortages. And in the case of housing, we're seeing new home sales. And again, looking back at these numbers is pretty instructive. They peaked in a year ago, in August a year ago at 977,000 units, and have dropped 30% to 676,000 in the latest report. Existing home sales peaked in October at 6.73 million units and have dropped to 5.86. So that's a 13% decline. Now, why is this? Well, as you'll recall, lumber prices shot up and all kinds of materials were in short supply. And we do know that a lot of builders just stopped building because they couldn't complete homes. And we've heard of some taking this summer off. So that could very well be the case. We also note that pending home sales are down 3.3% on a year-over-year basis. So building and sales slowing down. And you see this in lumber prices. Again, prices are the intersection of supply and demand. So I just gave you some statistics in the auto sector. In the housing sector, the home prices themselves are up nationwide 17% on a year-over-year basis, and in some sections of the country up 25%. But if you look at lumber prices, again, a leading indicator for very important industry. So lumber prices for random length lumber futures have dropped somewhere between 65 and 70% since they peaked in May. They peaked at $1,711, and they're now down to $538. One of the prices that has not given way yet, and is very important when it comes to inflation expectations, is oil prices. And oil prices just this week have had their biggest 5-day drop this year. So I don't know if that means anything. We do know that OPEC has increased its production and supplies. So that may have something to do with it, because they do not want to see demand destruction any more than needs to be the case as they fund their budgets. So at the margin, we're seeing some pricing indicators which are suggesting to us that the inventory drop that we saw in the second quarter, and it was a very big one, in fact, so big that it took the GDP growth rate well below expectations. Expectations were 8.5%, came in at 6.4%. All of this because of, most of it because of the inventory liquidation. It was a massive liquidation. And we saw, yet at the same time, we saw consumption much better than expected, up 12%. Think about that, 12% at an annualized rate. These are the sorts of consumption figures we saw maybe last time, and perhaps coming out of other recoveries, but back in the 50s, so very, very strong. Now, what we're wondering, if inventory reports are so low, what could be going on here to cause this kind of pricing action? And even copper has come down nearly 10 to 15%. And copper is the commodity with a PhD. As you know, we have been wondering if there has been a lot of double and triple ordering as companies were scrambling to catch up with the very rapid return of consumption after the depths of the coronavirus crisis. Businesses shut down, but consumers picked up pretty quickly. And businesses have been scrambling to catch the consumer, unsuccessfully, according to the second quarter GDP estimates. And so we've been wondering if, and lumber would have been a very good test case for this, if we're in an environment where there has been a lot of double and triple ordering, then what will happen as the supplies are coming on and prices peak is those orders will disappear. And the businesses who thought they understood how strong demand for their products were are going to have to rethink that. Now, we know that in the coronavirus, the 1 year that we were really at home most of the time, we were spending on goods, non-durable and durable goods. Goods typically account for a third of consumption, but we really couldn't consume many services, so that's where we spent most of our money. Now, during that year, it accounted for the consumption of goods accounted for 41%, and during certain months more than that, compared to that one third. For the largest sector of the economy, that is a huge shift, and so there was the scramble. Now we're shifting to services, and services, 2/3 of the economy, a lot of pent-up demand for them. We believe there could be this shift away from goods, and including autos, as we consume more services. The other thing that we're interested in seeing, and Clorox reported this last week, big disappointment. So stay-at-home stocks, not inventories, but equities, they peaked last summer, early fall, and among them was Clorox, and among them were many of our innovation stocks. So the Zooms and the Teladocs and other such companies. This week, or in the last few weeks, we've begun to see a bifurcation in stay-at-home stocks. The stay-at-home stocks like Staples, Clorox's, and the stay-at-home stocks, new digital world, hybrid work. So we were happy to see that, just to note, to take a little bit of a jog. But I do believe that Clorox is one of these companies that was scrambling to keep up with demand. There was double and triple ordering, and now they're seeing the fallout from that. So what does this tell us? These inventories are not at the business level. They're at the consumer level. And that might be the big fake out here. That might be the big fake out, that 12% gain in consumption was really inventory building at the household level, which is quite unusual. We don't usually do that, but we had a reason, and now maybe we have another reason. We have this the COVID virus picking up again, a new variety, and we may be seeing some preparation of that for that in the second quarter statistics. So this concept of inventory accumulation at home, I think we're going to see during the next few months, and it will explain if we see more price weakness in some of these goods categories, not so much services, but goods categories. That will be the explanation. And by the way, that will diffuse a huge worry in the market about inflation. Every time we get strong numbers, the market seems to, or algorithms seem to believe that this is bad for innovation stocks. But we actually don't believe that real growth is bad for inflation. In fact, real growth is going to be very good for productivity. We're already seeing signs of that. And productivity growth will enable companies to raise wages, which without triggering cost push inflation, which turns into an inflationary spiral like we saw in the 70s. 70s, we did not see the productivity growth. It was terrible. We are seeing a pickup in productivity growth thanks to the accelerated shift towards the digital world, which is much more productive. So I think that this dichotomy between value and growth is going to, we're going to get two answers in the near term. The first is real growth truly inflationary? And we would submit no. Productivity, thanks to innovation, is one of the reasons it isn't. Therefore, interest rates are going to continue to surprise on the low side of expectations. And as you know, Uh, the long-term Treasury yield, 10-year Treasury yield, peaked at 1.75-ish at the end of March, and this week dropped as low as 1.12. Today it's up based on this employment report, and so we're having a good value and cyclical day in the market and a tough day for innovation. But I think as more and more people begin to understand that real growth, especially if it is driven by innovation, and increasingly we think it will be, that real growth does not have to be inflationary and that interest rates do not have to go up. So if we get inflation coming down for the three reasons that we have been discussing with you over these last few months, the good deflation is innovation is innovation riding down learning curves, which are characterized by cost declines, which are passed through as lower prices. Think electric vehicles. We just learned today or this week that the Leaf with subsidies, its EV is going to drop below $20,000. I think the list price will be $25,000, but below $20,000. And even without subsidies, the price would be falling. So think of that. The cost of a car is going to drop, and we believe we won't need subsidies in a few years, is going to drop below $20,000. That is going to cause a boom. This is going to be the electric vehicle boom. And it has just started. The second reason we're going to see deflation is for a less good reason, and that's creative destruction. Disruptive innovation causes creative destruction. And the more we learn about the strategy that traditional automakers have adopted from a battery point of view, the more we believe that they're not going to be able to catch up to the likes of a Tesla, which is really driving this innovation. And we believe they're going to be stuck with a lot of inventory of inferior products, both the internal combustion engine and the electric vehicle side. And this latter point, we're learning a lot more about cylindrical versus prismatic batteries. Cylindrical is the Tesla battery, cell phone battery, 8,000 battery cells lining the bottom of a car. Prismatic, much simpler, fewer cells. So I think it's 200 or 400. But that is going to end up being a weak spot for these auto manufacturers. So creative destruction, they'll have to move these inferior products with lower prices. And we think that the problems in other industries that are disrupted by innovation are going to be worse because many of them have leveraged up to buy back shares and satisfy short-term shareholders who wanted their profits and they wanted them now. So we think this is going to become pretty pervasive, good deflation and bad deflation. And then the third source of deflation, which is what we've spent a bit of time on here, is cyclical deflation. If inventories are piled up in homes, especially of goods, then we believe that prices will unwind and really take the inflation argument off the table and take the fears associated with higher interest rates caused by higher inflation away. And actually, what that will mean is that the bull market, which you think about it this year, think about what we've gone through. We've gone through the ARK debacle. We've gone through a resurgence of the coronavirus, the threat of tax hikes, and now the fallout from China, which is the last topic I'm going to get to. And the bull market just keeps moving along. And so this move, this toggling back and forth recently between growth and value, we think will resolve towards growth as the cyclical dynamics of the economy turn much weaker than we've seen recently. So we believe that the bull market again will continue to strengthen as yet another group comes back into favor. It's unbelievable to think that the equity markets are up double digits this year, given all the headwinds we've been facing. And one of the biggest ones, by the way, was interest rates doubling in the first quarter. I couldn't believe that at the end of the first quarter, the market was up. So we're in a strong bull market. We really do believe that. Now, one last thing, capital may be flowing to our economy and other developed markets, and maybe other emerging markets from China because of what has happened recently. The government is cracking down. It has strengthened its crackdown. It started with Jack Ma. We just thought that was a bit of a power play last November. But that was really the beginning of a number of moves having to do with data privacy, data leakage. Data leakage would be DD, which right after it IPO'd, the government basically, in effect, is trying to shut it down. Certainly not allowing any new riders, or no one can load the app. So it sent a loud message about data leakage and making sure to go right through the right channels there. And then national security, another one having to do with data leakage. We saw the online education industry basically nationalized. They were declared overnight nonprofit. Many investors are thinking, oh my goodness, this is becoming an uninvestable market. We're not so sure. I think China's making it clear that it's less interested in feeding the digital part of the economy and much more interested in becoming much more self-sufficient on the manufacturing side of the economy. But in describing what it believed had happened to the online education sector, it said it had been hijacked by capital. And I think there's a focus on the mega caps there and the wealth created by them and the divide that has arisen. And I think online education was a real thorn in the side, because what we were seeing is the very wealthy were able to send their children to online tutoring sessions, which cost a pretty penny, and train for all the exams that they could would need to take to get into the best schools in the world, whereas the rest of the population did not enjoy that. So the other comment that we found notable in describing online media and game playing was different versions, spiritual opium or opium of the mind. And any of you who know Chinese history and know of the opium problems they had to conquer know how seriously they are taking this opium of the mind. They don't want their children. Children's minds dumbed by gaming and social media, TikTok and so forth, or their version of TikTok. And they in terms of the education, very interestingly, are banning foreign curricula from entering the economy, and they are forbidding the hiring of foreign teachers. My daughter taught for 13 months in China, and it was a fantastic experience for her. She loved it. And I know she's sad to see that go. But we don't think it's entirely uninvestable. We know that China does want to become the largest economy in the world, wants to be the most innovative in the world as well, wants to dial down some of the mass media products and the inequity that has taken place. But I don't think it wants to shut its economy down. That said, one of the reasons we think cyclical deflation is going to surface here is we do think China is slowing down. And some of these measures will, I'm sure, hurt confidence over there and cause more conservative behavior, perhaps exacerbating a slowdown. So with that, I will wrap up here just by re-emphasizing we don't think inflation's a problem. And yet everywhere I go, I tune into conferences, some of the finest name minds in the world. And, they express puzzlement at why long bond yields have gone down and basically say it's just because of quantitative easing. Well, quantitative easing has been with us this entire time of rates rising from 0.5 in the depths of the crisis to 1.75. We think the bond market is seeing something different, and it is more deflationary undercurrents in the economy than I think most economists and strategists perceive. But we will see. This is what makes a market. And as I always say, I don't mind being on the side of an argument where very few others are. Because if the markets have not incorporated it in or discounted it, and we're wrong, then we're not going to be punished that much for having that point of view. But if we're right, we could have just one heck of a good time during the next year to, I would say, 5 years, because we believe that the 5 innovation platforms around which we have focused all of our research, DNA sequencing, robotics, energy storage, artificial intelligence, and blockchain technology, along with the 14 different technologies involved in them, are going to lead to exponential growth trends, the likes of which we have never seen before. So, as we always say, stay on the right side of change and tune in to our website, ark-invest.com, if you want to read about all of the innovation we think is taking place and which is going to make our lives so much better, as long as we're on the right side of change. So thank you once again. Have a wonderful weekend.